Welcome back to another video here at Fiscal Voyage. I'm Felix, and today's video we're going to talk about Best Buy. With this pandemic and Best Buy stores being basically closed, they apparently are still making money, and I'm going to explain why and how. This video was suggested by Ike. Thank you, Ike, for commenting in the previous video. And make sure you watch the whole video because later at the end of the video I'm gonna give you guys a fair price for the company, and then from there we could give a recommendation if it's a buy, hold, or sell. So let's start with our stock analysis on Best Buy. Okay, here's the stock analysis on Best Buy. It can be found in the New York Stock Exchange as BBY. I'm sure you guys heard of Best Buy. They're all over America, which the company is basically a multinational consumer electronic retailer, which is headquartered in Richfield, Minnesota, and it was originally founded by Richard M. Social and James Wheeler in 1966 as a audio specialty store called Sound of Music. And then in 1983 was rebranded under its current name Best Buy, which with emphasis placed on consumer electronics, for example, computers, TVs, laptops, games, movies, all the electronic things you could find at Best Buy stores or online. So we look at the fundamentals. The company had a decrease on revenue from 2010 to 2019, compound rate of negative 1.4%. So revenue has been either flat or decreasing in a 10-year period. Net income, however, grew at a 4% rate from that same 10-year period. Currently, the company has a BBB rating, which is investment grade, and operating income also negative 1.2% in this 10-year time period, while earnings growth has been growing at 6.6% rate. However, the past 5 years, there's been an upside in revenue where it grew 2.5% for a 5-year period, and net income at a whopping 14.5%. So they made some drastic changes to generate profit. And mostly of this is with their consumer experience and online presence. And earnings in this 5-year period also grew at a whopping 21.6%. Hey, we continue with the fundamentals. For 2019, the company had earnings of $6.07. Actually, fiscal year ends in January, but we'll say 2019. Net margin is very tight at 3.53%. However, it is expanded slightly from 3.41 in 2018. Return on equity is nicely at 45%. Debt to cap is pretty reasonable at 44%. And they have a nice current yield at 2.84%. However, this current yield is slightly higher than the 5-year average, which is pretty good here at 2.53 is their 5-year average. So currently you get a nice yield based versus their 5-year average. They have a low payout ratio of only 43%, and they have a great dividend history of 17 years, which is something I didn't know until I started looking at this company. I normally stay away from retail because of the retail apocalypse, but this Best Buy has been doing great, as you can see here with a 17-year dividend growth, and they have a whopping 5-year dividend growth rate of 22.1%, which is outstanding. And this gives us a Chowder rule of 24.9, which is something very good. You like to see companies 12 and higher with a Chowder rule. So, and this one gives you a 24.9. And their most recent dividend increase came in February of this year at 10%, which is great considering the pandemic that we're going through, and they were still confident to increase the dividend at 10%. This is because they had a low payout ratio. If we look at the future, analysts expect 2020 earnings to come in at $5.09, which is a lot lower than the $6.07, which was produced in 2019. So earnings are expected to be lower, of course, with this pandemic, the store closure and things like that. But we'll talk more about that at the end. 2021 is expected to grow now at $6.17, and CFRA has a projected earning growth of 4%. a lot of analysts expect 4 to 5% earnings growth going forward. With my dividend drill return model, we have a projected total return of 11.1%, which is pretty good. I like to see company at 9% or higher, so this is very promising here. However, currently the company has a PE of 13.3 based on the 2019 earnings, but future earnings of $5.09 has a forward earnings of 15.6. So this is higher than the current PE, but still fair with the 5-year average of 15. If we look at the fast graph, you can see here the black line is the monthly closing price, the orange is the earnings with a multiple of 15, and the blue line is a normal PE of 12. Based on this, you can see that the company tends to follow the normal PE more than the 15 multiple. So we're going to use that for our fair value price, and you can see here is slightly higher than fair value based on this graph, or fairly valued. If we look at the fair value price, CFRA has a $67 fair price, Morningstar 64, Fastgraph at 61, Yahoo at 79, and my dividend discount model analysis at 58. Averaging out the price, we get a fair price of $66.08. Currently, the company is going for basically $80, which represents an overvaluation of 17%. So with that, I recommend this company as a hold. I personally wouldn't buy it at this price. I would like to see it drop a lot lower, maybe around the March prices, or maybe even lower than that for me to consider buying this company. But I think this company is not going anywhere because of the pandemic and the closure. They're financially sound, mid to low debt ratio. They have been growing the dividends amazingly, 17-year growth with double-digit growth rate. And also they have great retail experience in the sense that their stores are customer experiences. I personally like to go to their stores because of the experience. I like to play with the computers and things, so it's always an experience going to the store. So that's is a positive for them. And in April 15, Corey, the CEO of the company, had this to say, and I quote, "We have retained approximately 70% of our sales compared to last year since moving to our enhanced curbside service model, despite the fact of our domestic stores are closed to customers' traffic, and approximately 40 of them, practically in the Northeast, have been completely closed to all business for the last 10 days in our destruction." Barry continued, "This is testament to the strength of our multi-channel capabilities, as our domestic online sales are up 250%, and approximately 50% of these sales are from customers choosing to pick up their products at our stores since moving to our curbside service model." So basically, the stores are closed to come in, but people could still order online and come to the store to pick up their products, which is great. People like to get their products as soon as possible, then wait a few days. So they're still making sales online, as you can see, 250%. So with that, I have a whole recommendation, but I don't think the company is going anywhere. But at the current price, I'm not buying it, and I recommend it as a hold. Again, I love the dividend history and dividend growth, and they won't be going anywhere. But at current prices, I wouldn't buy it. So with that, thank you for watching. If you have a company that you would like to see next, please let me know the name of the company and the ticker symbol in the comments. And if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And don't forget to check my portfolio, which there's a link in the description below. Thanks, and stay safe.